And then we'll have a brief discussion as to whether or not we still do transfers of ownership. And my whole focus today is going to be corporate. Okay, it's not any transfers personally, but it's going to be corporate. So right off the bat, transferring ownership of a life insurance policy is considered a disposition for tax purposes. So we make a transfer, automatically we have to think about what are the tax implications. There may be none, but I know that when there is a disposition, then there's going to be some sort of a potential tax issue, depending on the attributes of the policy. And by attributes, the main ones that we look at are ACB, the adjusted cost base of the policy, cash surrender value of the policy, and fair market value. So depending on those attributes, at the time of the transfer and the parties which are involved in the transfer, a policy gain may arise. We all know that. Policy gains are not capital gains. I put that in big cap letters. They're not capital gains. They're fully taxable for tax purposes. So there's no 50% inclusion. If you have a policy gain of $100,000, it's a full taxable gain. And the disposition of a life insurance policy cannot give us a loss for tax purposes. So if cash surrender value or whatever proceeds of disposition are below adjusted cost base, no loss for tax purposes. What I'm going to focus on for the remainder of the 45 minutes is non-arm's length transfers and how the federal budget of 2016 impacted transfer of ownership rules. So what are the most common types of transfers? The following lists the most common types of non-arm's length transfers. Transfers between spouses, intergenerational transfers, and those are transfers between parents, children, and grandchildren. Transfers from an individual to a corporation, transfer from a corporation to a shareholder, either individual or corporate, transfer to a sister corporation, and transfer to a trust and from a trust. And as you can see, I've bolded the two areas that I'm going to focus on today. Not to say that the other areas aren't important, but already in those two bolds, I'm going to be taking at least 45 minutes to discuss these topics. And let's quickly define what non-arm's length is. So generally speaking, related persons do not deal at arm's length. A corporation and its controlling shareholders do not deal at arm's length. A person that is part of a related group that controls the corporation does not deal at arm's length with the corporation. A corporation that controls another corporation does not deal at arm's length with it. Holdco-opco situation. And any two or more corporations that are controlled by the same individual or related group, they don't deal at arm's length with each other. So, I'm going to take us back to pre-March 2016, and I'm going to talk about those rules. Again, bear with me. I know they're not still in effect, but it's important to talk about them so that we all are on the same mind frame. The policy gain on the disposition is calculated in subsection 148(1) of the Income Tax Act. And it goes as follows. Proceeds of disposition less adjusted cost base immediately before the disposition. Okay. So what are proceeds of disposition? Well, then we look at 148(7) of the Act. And proceeds of disposition were defined as the value of the policy. Okay, well, next step. What's value of the policy? Well, the value of the policy was defined in 148(9) to be the cash surrender value of the policy. Okay, we're all on side. And in 148(7), 148(7) also deemed the adjusted cost base of the policy to the recipient party. So we have a transfer. What's the new adjusted cost base to the person receiving the policy? And that was also defined to be value of the policy. So essentially, it would be cash surrender value. And all of this in plain English is policy gain equals cash surrender value minus ACB. New ACB equals cash surrender value. And if the adjusted cost base was greater than cash surrender value, no policy gain, no policy loss available. That's pretty straightforward. That's what governed us pre-March 2016. And up to that point, it all made sense. But the piece that was missed in the Income Tax Act was how do we address for fair market value of a policy? How does that factor into proceeds of disposition? So when the Income Tax Act was written specifically to transfers of ownership for life insurance policies, it missed this whole discussion of fair market value. The rules totally ignored fair market value and therefore allowed for a great opportunity. And we all know in the room what that great opportunity was. If the fair market value of the policy was greater than cash surrender value, then value was still calculated as cash surrender value. Therefore, and here's the big opportunity that existed, does not exist, existed. I have to keep on reminding you. Therefore, no policy gain was calculated on the difference between fair market value and cash surrender value. So a quick example, consider a transfer from a shareholder to a corporation that the shareholder owns all the shares of, 100% owned by the individual. Policy has the following attributes, and I'm going to use this example throughout all of my presentation. Cash surrender value equals $100,000, adjusted cost base equals $200,000, fair market value equals $300,000. So policy gain pre-2016, simple calculation. Value, which equals proceeds of disposition, which equal cash surrender value was $100,000, minus adjusted cost base equals $200,000 in this scenario. My policy gain was $0. So if I were to transfer in individually this policy, I'd have absolutely no tax to report on an individual basis. So we got Frank, and Frank is the sole owner of corporation. He personally owns this life insurance policy. He went out and got a valuation done on the policy, and we'll touch on valuations in a second. And the policy was valuated at $300,000. That was the fair market value. Frank transferred it into the corporation, and there was zero policy gain, as I calculated earlier. New adjusted cost base to the corporation is $100,000. So just like that, and I put that little footnote, the transfer has been reduced. It's reduced the policy ACB down from its calculated amount. What do I mean by that? Well, we all know that when we're calculating the ACB of a policy, there's a formula. Basically, funds in minus NCPI on an annual basis. Now, when I do this transfer pre-2016, and I'm putting it into a corporation, I'm going to use the word artificially. I've artificially reduced the adjusted cost base on that policy. It's important that you remember that. That was an artificial reduction. Now think of it from the benefit 100 years later, because I don't want to die until 100 years later. My adjusted cost base on the corporation is essentially $100,000 reduced on that transfer. And forget about the 100 years later. Let's say I die tomorrow. Didn't I just enhance my situation pre-2016? I got a lot of nods, so everyone understands this. That was abusive in itself. The fact that I got this artificial reduction in my ACB by doing this transfer because the rules were not really written appropriately. So the corporation now owns the policy that was transferred in by the shareholder. What does the shareholder get in return for the transfer? And that's the piece that really gave us an opportunity. So anytime, and I always tell people this when I get asked this question, and this is why I'm writing this topic, because on a regular basis, the questions of transfers of ownership come up. And suffice it to say that if you deal with corporate clients, a transfer of ownership is imminent. That topic may happen. I'm not going to say likely, but it's probable. Lawyers in the room, what's the difference between likely and probable? So, transfer in an asset worth $300,000. Now, let's step aside from life insurance. I just want to make this point. If I were to transfer in a building that had a fair market value of $500,000, what should Frank get back for the transfer of that building? Ignoring the tax on Frank's perspective. And let's just assume that I just bought that building. I paid $500,000 personally. And my accountant said, what the heck are you doing, Frank? You should have bought that in the corporation. You need it in the corporation. It's a corporate asset. You could use that building. So I say, okay, Mr. Accountant, help me put it over to the building. What should the corporation pay me for that building? I'm just trying to figure out what's the value that it should pay me. It should pay me $500,000. So, should I have a taxable benefit? Should I pay tax on that money coming out of the corporation for the $500,000 asset that I'm giving it? Absolutely not. So that's where the big opportunity was. I'm transferring an asset, I'm giving the company something worth $300,000. When they give me $300,000 in payment for that, there's no tax implications. And there shouldn't be. Does that make sense? That's the whole crux behind why people were doing this. Right? Huge, huge opportunities, and many of us were advising. Transfer in a policy, get a fair market valuation, because whatever that fair market value of that policy is, you will not pay personal tax on that. The only personal tax you have to worry about is the policy gain, and as long as the cash surrender value is below the adjusted cost base, nothing to worry about. So let's get out and get the highest fair market valuation, which is supportable if we get challenged in court, because that's a way of us stripping out as much cash as possible tax-free. That's it. If you never understood that before, that's it in a nutshell. So recap of that transaction. Policy gain to shareholder was 0. Tax owing on the disposition to shareholder, 0. Cash paid to the shareholder was fair market value. I gave it an asset worth $300,000. Tax paid on the $300,000 that I received, 0. Just paying me back for something that I gave the corporation. In summary, regardless of how much the fair market value of the policy would be, the tax on the transaction equals policy gain, which equals cash surrender value minus adjusted cost base. The incentive, have the policy valued as high as possible within reason. So I sit here after talking about this, and the more I talk about it, the more I realize the changes in rules. I always realized this, but I hope that you're realizing that the changes in rules made sense. We may not have liked it, but they made sense. Tax rules pre-federal budget 2016 clearly did not address this unintended result. It's not as if they purposely did that and said, you know what, insurance industry, go out to town and exploit this unintended result. The changes that were imposed were not a surprise to us, and the issue was always, when will the change be announced rather than if? Every budget day, today's budget day, always around budget day, people would call me and say, Frank, is it going to happen? Is it going to happen? I don't know. And finally, in 2016, they pulled the trigger. New rules now address this unintended benefit. Okay, so now we're going to transition. So let's forget about everything Frank talked about. Let's transition to post-March 2016 current rules. 148.7, subsection 148.7 of the Income Tax Act provides the rules applying to a disposition of an interest in a life insurance policy on non-arm's length transfers. Policy gain on the disposition is calculated in 148.1 as follows. Proceeds less ACB immediately before the disposition. No change there, but the big change comes in how we define our proceeds. Proceeds of disposition are now going to be the greatest of the value of the policy, and again, value of the policy will be cash surrender value, the fair market value of the consideration given for the interest in the policy. So that's important. So it's not necessarily just fair market value, because you can have a fair market value that's through the roof, but as long as there was nothing given or paid for it, then that's fine. It doesn't come into factor on proceeds. It's the fair market value of the consideration given for the interest in the policy. And the third thing is obviously the ACB immediately prior to the transfer. In plain English again, policy gain is going to be proceeds minus ACB. Proceeds of disposition are the greater of cash surrender value, ACB, and fair market value paid. If the fair market value paid is greater than the adjusted cost base and cash surrender value, a policy gain will result. So right there, that line tells us that this whole opportunity has been eliminated. The opportunity of valuing as high as possible and having no taxation on the difference between fair market value and adjusted cost base, that's gone. If cash surrender value is greater than ACB, then a policy gain will result. That's the same as before. That's never changed. And note, Here's a huge note. This is going to fix, remember I made a footnote about the new ACB to the corporation, right? And I called it an artificial reduction in ACB. Well, the new ACB cannot be lower than the ACB prior to the transfer. So with these new rules, you cannot get a benefit in a reduction in ACB, because at minimum, the proceeds of disposition will be ACB. So I'm going to revisit the example. Again, same policy. Fair market value $300,000, cash surrender value is $100,000, ACB is $200,000. What's my policy gain? I don't know. I don't know. I have to figure out what the amounts transferred are or what the amounts paid are. Frank, what's my new ACB to the corporation? Again, that's going to depend on proceeds of disposition. So, under scenario 1, what if my corporation pays me at least $200,000? Or they pay me $200,000. I don't want to say at least. They pay me $200,000. And the $200,000 is exactly what the adjusted cost base is on that policy. So if they pay me $200,000, I go back to my formula. What are proceeds of disposition? It's the greatest of cash surrender value of 100, ACB of 200, or the fair market value of the amount paid, $200,000. So I revert to $200,000 as my proceeds of disposition. Policy gain equals $200,000 minus $200,000, zero policy gain. What's my new ACB? Well, here's where the big difference happens. Prior to the rules, my new ACB was $100,000, and there was that artificial reduction down to cash surrender value. Now, there's no playing around with it. My ACB is what it should be as per the rules calculated the way the insurance industry calculates those rules. It's $200,000. What if I received payment of $300,000? Okay, well, now there's an issue. The issue is that I'm going to have a policy gain. I go back to my proceeds of disposition formula. Proceeds of disposition formula says the greater of cash surrender value, not worried about that, it's $100,000, ACB, $200,000, or fair market value of amount paid. Well, here, the fair market value of consideration or amount paid is $300,000. So now when I calculate, I have $300,000 minus $200,000 ACB. I have a policy gain of $100,000 personally. Frank has to pick that up in his personal taxes. New ACB to the corporation. New ACB to the corporation is going to be $300,000 now. Proceeds of disposition. Ouch. That's a double whammy. It's a double whammy because not only do I have to pay tax on the amount transferred in on the policy gain of $100,000, but now I've artificially bumped it upwards, the ACB. So I'm doing a disservice to my CDA credit because of the new rules. I'm going to go back a slide. Notice that even though the fair market value in my previous example, even though the fair market value was $300,000, if I elect to only take back $200,000, I don't have to have a policy gain calculated. That's important to know. Just because the value of the policy is above the ACB doesn't mean you have to take back the fair market value of the policy. Okay? I see a lot of nodding heads. They're saying, yeah, we get it, Frank. Move on. Comparing the two results, this is just me highlighting again the important points. On pre-March 2016, so if we did this pre-March 2016, we'd have a policy gain of 0 because it would have been proceeds, which are value, which are cash surrender value. 100,000 minus 200,000 gives us no gain, so I'd have policy gain of 0. Proceeds received tax-free would be 300,000 to the shareholder, and the new ACB to the corp is 100,000. On the right-hand side, post-March 2016, I have a policy gain. If I've transferred at fair market value, I have a policy gain of 100,000. I still don't have to report the payment of the 300,000. So I only have one taxable transaction there personally. Does that make sense? The 300,000 that I'm receiving is still not taxable income because I've given value to the corporation worth 300,000. Does everybody get that? What I'm talking about is this number right here. It's still tax-free, that payment to me. But that payment to me comes at a price. It comes at a price in the sense that I have to pay a policy gain, or I have to pay tax on a policy gain personally. And look at this. The other issue is that my new ACB to Corp has just been bumped up. Just as an aside, if it was going out of the corporation, that's a good thing if we get a bump up in ACB. Right? If you think about it, if I'm taking that policy personally and I get a bump up in my ACB, I like that. Because as an individual, what can I do with a higher ACB on my policy? Well, I could take policy loans on that policy because now I have a higher ACB. And policy loans aren't taxable until we get down to a 0 ACB. Or I can do withdrawals of the policy if I have cash surrender value, and now I have a higher ACB, which reduces my policy gain on withdrawals or surrenders, partial surrenders. I don't want to waste too much time on this because this is beyond the scope, and I think everybody can recite how fair market value is calculated. There's an information circular that the CRA, or Revenue Canada, has put out, IC 89.3, and here's some of the factors to consider in valuing a policy. I don't value policies, by the way, and what I say is I urge you, if the policy is large enough and it's important to get a valuation, get an actuary. We all know that there's actuaries out there that do this. Get the proper actuary to value the product, or value the policy. So quickly, what is looked at? Cash surrender value of the policy, policy loan value, face value of the policy, state of health, of course, that's an important one. The more ill the individual is from the time that they've taken out the policy, the higher the fair market value potentially. Conversion privileges, other policy terms such as riders, and replacement value of a policy. Excuse me while I see my time. I'm going to pick it up a bit. So here's the question. Should a shareholder still transfer a policy to a corporation? I think it's a good question, and it's one that I'm asked often. And I think here's an easy answer for me to give. It depends. It's not always a slam dunk. It's not always, yeah, you should, or no, you shouldn't. So first things first, will there be a policy gain? Let your client know that this transfer may create a policy gain. You should know it. The easiest way to find out, go to the insurance company, right? Ask the insurance company to give you what the gain would be on a transfer. Consider this, how many more payments are owing? So if you're 5 years into a premium paying that requires 20 premiums in total, you have another 15 premiums to go, I'd say probably makes sense to go into the corporation. But if you're 9 payments in and you have one more payment, consider it. I'm not sure. It's not a slam dunk. If you transfer in, are you still taking proceeds out of the corporation tax-free as payment? So I'm still getting my money out. That's the good thing. Remember that. If I'm transferring a policy in, I'm still getting repaid for that. And when I get repaid for something that I've paid for myself, that's not a bad thing. Either I get it from cash, if the corporation has the cash, or we set up a shareholder loan. So that's always something to think about, is even though I have the policy gain issue to worry about and the new ACB issue to worry about, at least I'm getting back a repayment for what I've paid personally. I hope that makes sense. Is it transferred to an OpCo or to a HoldCo? Well, if it's to an OpCo, I have to worry about, is there going to be a future sale of OpCo? Because if I've transferred in, then guess what? I might have to transfer either out to myself or out to a HoldCo, and I may have taxable disposition issues to worry about. And then, of course, as always, even when we make the initial sale to the corporation, once I put the policy to a corporation, the corporation is going to be the beneficiary, so I lose my creditor protection status. So quickly, just a quick summary. What if I change the parameters on my example? ACB is 100,000, CSV is 100,000, fair market value is 450. The transfer happens at 450,000. Okay, so the amount paid was 450,000. Policy gain, 450 minus 100,000, we have a $350,000 policy gain. That's bad. ACB to the corporation now is 450,000. Credit to the CDA is death benefit minus ACB, so yeah, that's bad as well. So in this example, a transfer at 450,000 is bad. What if that same example, the transfer happens at 100,000, right? We've elected not to take the fair market value. We've elected to do the transfer at ACB or cash surrender value. So policy gain is 0. I'm okay with that. ACB to the corporation is 100,000. That's no different than it was before. Credit to the CDA is death benefit minus ACB. I'm okay with that as well. And how much is the company going to pay me for that? $100,000. I'm okay with all of that. As a tax person, that jives with what the tax rules should have been to begin with. So I'm okay with all of this. I'm not okay with this in terms of whether or not I would do it. I don't like the fact that I have a policy gain of $350,000, fully taxable, not 50% of it taxable. And I don't like the fact that I've artificially bumped up my ACB, bad mechanism for CDA purposes. Again, I don't know what the face amount of this policy is, so I'd have to step back and see all the parameters, but generally speaking, that would be a bad situation. This is the one where you take a deep breath. I think a lot of people know this, but I just want to put this out there. My client's transferred for fair market value well before the changes in rules happened, so none of this affects him, right? Wrong. Wrong. Now is where I'm going to get a little bit more technical. If you didn't like that, well, you're going to hate this. I'm being honest. I hate this. For transfers made prior to 2016 and after 1999, and I think that any of the transfers that took advantage of the rules would fall into this category. There's going to be 2 potential grinds to the CDA. First is a fixed grind, meaning you will never lose this grind. A grind is a bad thing, by the way. Grinds to the CDA. The fixed grind says proceeds received on the transfer in excess of the value of the policy are going to reduce the CDA credit at the time. This one's an easier one to understand than the second one. I'm going to get in depth with numbers. Declining grind. This one we can get down to 0, but it says the amount by which ACB or fair market value, whichever is left, exceeds CSV at the time of transfer, minus the amount of negative ACB at the time of transfer. So what we're getting at here, remember I talked about an artificial reduction in ACB? Well, the CRA says if you did that, we're not going to give you that artificial reduction in ACB. When the CDA has to get calculated at death, we're going to assume that your ACB was back to normal, and then we're going to look at negative ACB and take it off of that amount. Suffice it to say that when you see the numbers, you'll get a better understanding. So back to my example. Fair market value, $300,000 of the policy that I put in. Cash surrender value, I'm going to assume was $200,000. ACB, $200,000. Policy gain was 0. New ACB to the corporation, and again, this is the pre-example. New ACB to the corporation at the time that I did the transfer was $200,000. So what's the fixed grind here? Well, when I did this, what did I get back tax-free, where there was no tax to worry about before the rules changed? I got back $300,000 instead of $200,000. So how much tax-free proceeds did I get out of the corporation? $100,000. If the face value on this policy is $1 million, and the CDA at time of death is calculated as $1 million minus ACB of 0. If a CDA was $1 million, and we paid out $1 million tax-free, plus the $100,000 that we got tax-free originally on the transfer, we're up to $1.1 million tax-free. That's more than the $1 million CDA. So what does that mean? That means that I will never lose that fixed grind. I will always have to grind my CDA by $100,000 for the amount that I stripped out due to the rules. I see a lot of nodding faces. It makes sense, right? So fair market value received when I did the policy transfer pre-2016, I got out $300,000. My policy gain was nothing. I took advantage of these nice rules. So I got out $100,000 tax-free. That's going to be my grind forever. Death benefits $1 million. ACB at death is 0. Credit to the CDA account is going to be $1 million minus the $100,000 that I got already. It's almost like I got an advance on my CDA. Okay, so that's the grandfathering rules that you have to be worried about. I wouldn't say worried about. It's not a big thing, but just make sure that your clients and their accountants are aware of this. Because if they claim a full $1 million CDA, they're over by $100,000. Tax-free proceeds, well, I'm okay. If the CDA is $900,000 and I've already gotten out $100,000 tax-free, that's $1 million, I can explain that to the client. I have no problem with the client saying, why didn't you tell me about this? Well, at the time when you did the transfer, those were the rules, but this isn't overly punitive. You're still getting your $1 million tax-free. You've taken 100 plus 900. Yeah, I know, we're in sales now and it's not as good as the full $1 million, but that's the justification. So what's the declining grind? Well, the declining grind says that when I did the transfer, if my CSV was 100, I gave myself an artificial ACB of 100,000. So my new ACB was 100 when it should have been 200,000. So all the declining grind says is we have to keep on tracking the ACB because you gave yourself a $100,000 ACB. When you hit zero, it's not really zero. Does that make sense? When you hit zero with this new ACB, it's not really zero. It should have been 200,000 minus whatever all the grinds would have been. So all they do is they just keep tracking what the previous ACB should have been. So let's assume that I have a negative ACB of 50,000 at time of death. That would have meant that if I had my original ACB in place, I would have had a $50,000 ACB. Instead, they're saying, well, Frank, now we have to adjust, and your new CDA credit will be 100 minus the negative ACB of 50, so you get a CDA credit of 950. It's basically putting me back to the ACB that I had before I made the transfer. That's the easiest way to do this, because this declining grind could get a little bit challenging. But just suffice it to say that it puts me back to the ACB that I would have had if I didn't do the transfer. Does that make sense? To me, it makes sense. I think it makes a lot of sense in the sense that this was an artificial reduction, so this declining grind rule, and remember, I might get a negative ACB. If the years go on and on and on, my negative ACB might end up being over 100,000. And that's fine, because then I get a full CDA credit. But all they're saying is, Frank, Mr. Client, Mr. Corporation, we have to put you back to the original ACB before you did this artificial reduction, and that's really the new ACB for the policy. So transferring a policy out of a corporation into a shareholder. First, we'll touch on that. Most common reason to transfer a policy out of a corporation into the shareholder personally is, of course, due to an impending sale. I always tell people, why would you want to hold it personally if the mechanism is very similar? You're going to get tax-free proceeds anyways via the CDA account. But if we're selling the company and there's no holdco involved, yes, we have to transfer it out personally. What are the corporations that are most likely to do this? Think about it. What corporations, and I know a lot of you have these clients, dentists, doctors, basically professional corporations that aren't allowed to have a holdco, they're the ones that are going to come to you the most to say, what do I do? I'm selling that corporation and there's that big insurance policy in there. What do we do now? Because I'm not selling the corporation with that insurance policy. So these transfers in the past, they typically happened at cash surrender value since there was no advantage in transferring at fair market value. So we've got to keep in mind now, when it goes the opposite way, when we're stripping an asset out of the corporation and to my pocket personally, then there's a differing tax reporting, right? When I'm giving my company an asset, whatever the fair market value is, I could take that back tax-free. But the opposite, when I'm taking something out of the corporation, that's taxable to me, right? So we have to watch out. There's two taxable transactions to consider anytime a policy is coming out of the corporation into the individual. The first one, and the one that all of us are on top of, and the insurance companies are on top of, is the policy gain. So I first have to figure out what's the policy gain to be reported by the corporation, who's the transferor. But the second one is the one that a lot of us miss. And it's up to you and the accountants to know this. Don't rely on the insurance companies. This is the one that I'm going to tell you with certainty. Do not rely on the insurance company to help you on number two. Fair market value of the property received by the shareholder is a taxable benefit. In big bold letters, insurance companies provide information for number one, not number two. Number two needs to be addressed by the client's accountant with your assistance. Now, as an accountant, I know immediately. First instinct is that when you're transferring something out of a corporation, be it cash, be it property, be it land, be it building, if you're transferring it out to someone personally, I know there's a benefit there. We have to figure out what the tax consequences are. So they should be in tune with this. Now, the second thing is, what's the fair market value? Well, I don't go to the insurance company. I don't go to Canada Life, Sun Life, Equitable. I don't go to any of them to say, give me the fair market value of the policy, because they're going to say, we don't do that. That's not what we do. So be cognizant of this. This is something that you and the client's accountant have to figure out. What's the taxable benefit of the amount or the value of the insurance policy being stripped out? So quickly, again, fair market value of this policy is $300,000, and I'm going to assume ACB and cash surrender value was $100 on each. On the right-hand side, let me deal with the corporate issue first. Policy gain. So we've taken back $200,000 for this, less the adjusted cost base is $100,000 on it. Policy gain is $100,000. I'm sorry, I didn't lay out the parameters very good here. On this example, I'm assuming that cash surrender value is $200,000 and adjusted cost base is $100,000. I'm sorry. So if I transfer it out at cash surrender value, I have a policy gain of $100,000. Right? Cash surrender value 200 here, ACB 100, fair market value 3. So when I transfer it out at cash surrender value, I have a policy gain of 100,000. That's the first issue. Here's the issue, here's the whole side that people miss. Well, it doesn't matter what it was here, what's the fair market value of the asset removed? So I get totally out of the rules of life insurance taxation, and now I'm into the rules of taxation of an individual, of a shareholder, and the relationship with their corporation. So the fair market value of the asset that was removed was $300,000. I have to report a $300,000 taxable benefit on my personal T1. Okay? Very, very important that you know this. This is really important. So what's my incentive when we have that discussion with the actuary on valuation? As low as possible. Fair market value as low as possible, as long as it's defendable in court. What if I transferred out at $300,000? Okay, well at $300,000, my policy gain is going to be, under the new rules, the $300,000 fair market value paid, less ACB of $100,000. I have a policy gain of $200,000, but if Frank paid $300,000, if I paid for it, then I have no taxable benefit. How many people are actually going to pay for that fair market value coming out? I'm going to suffice to say less than 10%, and the over-under on that is probably 10%, right? Not too many people are going to pay. So suffice it to say that 99.9% of the time, this is what's going to happen in these examples, is you're going to have a policy gain equal to cash surrender value minus ACB. There's not going to be anything paid back, and I'll have a taxable benefit to report of $300,000. That's a huge issue. And again, the insurance companies will not be giving you the guidance there. And finally, I'm sorry, I'm going to impose, I'm already at 10:45. Please bear with me for another 5 minutes just so I wrap this up. Is that okay? Okay. So instead of transferring a policy out of a corporation to the individual, what if we had a holdco? Right? Because I want to obviously get away from this. I want to make sure that I don't have that taxable benefit. But what if I have a holding corporation? Well, if I have a holding corporation, I'm going to do what we call an intercorporate dividend. Right? We always talk about OpCo paying dividends to HoldCo, and those are intercorporate and they're non-taxable. So who's to say that I can't pay a dividend in kind, and the dividend in kind is in the form of an insurance policy? Absolutely. We're able to do that. So if I do that, I still have to talk about the policy gain. Sir, you mentioned this. I still have the policy gain to OpCo, but I don't have to worry about the taxable benefit part of it. So the impact, policy gain to OpCo, still, if I do it at cash surrender value, $200,000 less the ACB of $100,000, I have a policy gain of $100,000. I can't get away from that. But now, because it's going as an intercorporate dividend, it hasn't left the corporate group, I can basically call that an intercorporate dividend with 0 taxable benefit. Much better scenario than transferring it to myself individually. And this is a scenario that you're going to get into when your client says, listen, I have a sale imminent. When a sale happens, we always sell the shares of OpCo. We don't sell the shares of HoldCo. So I have a share sale imminent. How do we help take that policy out? Generally, we do this. We pay an intercorporate dividend, suck it up, pay the policy gain, pay the taxation here, and then you have no taxable benefit on that transfer. I think that from the 45 minutes that I took, you know that this whole area of transfers of ownership could be a minefield. So be cognizant that when you're doing a transfer, there's going to be issues. Be cognizant that if you've engaged in any transfers, there may be issues. And what I'm going to say is, honestly, engage the client's accountant, because when it's corporate transfers that are being involved, there's always going to be an accountant, and they should be involved with these issues.